Hey everybody, it's Andy Reynolds, COO, and financial advocate here at Ballast, here with Brian Burton, our Chief Investment Officer. We wanted to take an opportunity to talk to everybody about the markets, the economy, and start our second quarter, about halfway through the second quarter market economy conversation. So with that, Brian, I'm going to turn it over to you and let you jump into things.
Great. Thanks, Andy. Thank you all for tuning in. Glad you're here, and hopefully we can share a few insights on what we're seeing in the economy and markets, and kind of what we see moving forward. So we'll jump right in. I want to say thanks to Madeline, who is helping control the slide deck today. So thanks for that, Madeline. And with that, we'll jump right in. So I think kind of the framework for how we think about the economy and markets is really looking at what some of the positive backdrops are that could help economic growth and help markets move higher, and what are some of the challenges that we're currently facing, that we're kind of seeing coming down the road, and then kind of using those to help us make allocation decisions, risk management decisions, etc. So let's start, kind of with the more challenging side of the aisle, which will be the headwinds. So you can move forward one there, Madeline. That'd be great. Let's see. Okay, so we're looking here at the Fed funds rate and CPI. So if you think about the Fed's dual mandate of, so two things that they're really challenged with, which is price stability, so keeping inflation in tame towards 2% is the goal there, and full employment is the other mandate of the Fed. So what we're looking at here is that inflation has cooled off the peak level of about 9%, but it still remains above the Fed's target. And a lot of that inflation is coming from services and energy related categories, particularly with the recent spike we've seen in crude prices. The top line is obviously the Fed funds rate. So we've seen the Fed has lowered rates from, well, we were about 5.25, and now we're standing at about 3.75 on rates. So CPI's kind of drifted back up while the Fed funds rates come back down. What's interesting now is that it's kind of probably puts the Fed on hold from lowering rates further. It's difficult to make a case for lowering rates when we have inflationary pressures that we have at the moment. So cool from the peak, but we're still seeing some signs of it heating back up. So since the pandemic, we've seen, if you think about the components of CPI, shelter, services, goods, we've seen core services have really remained a larger contributor to inflation, whereas the shelter component did initially shoot up to over 3%, but has since returned and retraced to kind of near pre-COVID levels, where the services sector has still remained elevated and a big contributor. Another interesting part, if you break apart CPI, is that if you look at the core goods category, post GFC, going all the way back to 2009 or so, all the way up until the pandemic, core goods were actually kind of a deflationary component of CPI, with the exception of pieces of 2018 and 2019, which was Trump's first term and his first round with tariffs. But following the pandemic, we had the supply chain shocks that drove cost of goods higher. But if you go to 2024, core goods were back to being a deflationary component. Now, fast forward to April of 2025, we had this tariff tantrum. It's this round of tariffs initiated in April of 2025. Core goods since then and to this day are once again contributing to inflation. So we've seen that those costs pass through on the good side to the consumers. That's keeping it's keeping that overall inflation number a little bit elevated. Um, we did have a big drop off in shelter costs that I mentioned. The peak there was kind of early 2023, and that the shelter costs are almost back to where we were pre-pandemic. Um, and then we had this huge drop off in October of '05 in the shelter area, which ironically syncs up to when the government shut down and they were reporting 0% inflation on shelter. So it's just something interesting to note there. So
I
um,
think, Brian, as I look at things, I think this storyline between the two of these are going to be really interesting over the next quarter, next 6 months. It's such an influence in the economy. So effectively, what we're looking at here is how much do things cost, and then how much do I have to pay to borrow money? And as we look at the CPI and we look at cost, whether it's a service or a good, where we are with oil, and I know we'll talk about oil in just a second, but where we are with oil, I don't think everyone realizes how much oil plays a factor into
mhm.
everything we do, everything we pay for. You think about just like the lawn maintenance company, and you think about, okay, that's a service. You don't think about their input costs, but there's so many input costs that go into lawn maintenance, and it's the gasoline, it's the travel from one place to the next place, it's the cost to make the equipment, it's the cost to repair the equipment, and those things that are being made to build the equipment, it takes energy and it takes cost. So if oil stays where we're at, um, I think we continue to see challenges within the energy space and within really everything for costs of goods and services, because it just touches so many things. Um, and as you'll talk about here in just a second with the rates, Kevin Warsh was maybe not brought in to hopefully lower rates, but to your earliest comment of the Fed maybe having to sit tight, this is going to be a storyline that is definitely going to be, I think, leading the headlines for the second half of the year.
Yeah, I agree, and that actually leads into the next slide. So another headwind that we're dealing with, obviously interest rates, and the thought was we were going to get a couple cuts. If you look at this chart, it's really pretty neat graphic here. So um, all the way up until March of this year, two rate cuts were priced in for 2026. Um, and then you can see there where the war in Iran began in March, and now to this point in time, we're expecting no cuts. So in fact, there's a higher probability of a rate increase in 2026 than there is a cut at this point. So um, a lot of that's to do with inflationary pressures that we mentioned, um, uncertainty on policy. There's a lot of things that go into that move higher, and that the probability of a rate cut declining so drastically. So Treasury rate yields remain elevated. So it's obviously that increases borrowing costs for consumers, it increased borrowing costs for corporations, and not to mention the federal government um, paying over $1 trillion in interest on the debt every year. So um, the next kind of challenging aspect, obviously, the geopolitical pressures, what's going on in the Middle East, uncertainty there, and what that's done to the price of crude oil, which we did briefly mention. So if you'll flip one here, Madeline, we can take a look here at the price of crude going back to 2008, and several different periods of wild volatility in the futures of crude. But as we stand today, just over $100 a barrel. So I mean, it's increasing energy prices for everyone. It's hurting the lower to middle class, probably more so with price at the pump. With a five handle now on fuel costs, it creates volatility in markets, and volatility at home, and your daily finances for consumers. So, as Andy mentioned, it's hard to find an area of the economy or on your household cash flow or balance sheet where price of oil hasn't had an impact. So something that we watch closely, but with the uncertainty in the Middle East, it's just so hard to predict what will happen in these markets. And we try to prepare as best we can with our allocation decisions, and try to find areas of the market that are less impacted, or a little more have a bigger moat, and things like that we can avoid volatility in those prices. So another headwind is that definitely working against the economy and markets is the federal debt levels. If you'll flip one forward now. So,
Brian, can I add one comment about the oil real quick?
sure, absolutely.
I, I think something else. So I just looked up the current national average is $4.50 a gallon. So here in Lexington, we're a little bit below that right now, or at least we were last time I filled up. Um, and we've seen low fours earlier. If we go back to, those early 2010s, you can look at the chart, and obviously 2020 oil was all over the place. I do think there's a psychological hurdle to if we get above $5 a gallon on the national average. Those will be numbers that we've not really seen for an extended period of time. And we're in the period of time where gas prices switched to the summer blend. I believe we just started that transition. I think by June 1 or June 15, it has to be over into the summer blend, which is a little bit more expensive as well. So we have that going against us. So, you know, as we get into the summer travel, it's vacation time. It's, going to spend time with family, friends. Feel bad for the person who bought that new boat. Super excited about this summer. It's going to be a little bit more expensive, but I do think it's something that, as we get into the way people feel about the economy, the way they spend their money, the way they sometimes we can create things just based on our own reactions to what we're seeing and feeling. And I do think we have to really pay attention to the prices at the pump, because if those get above $5, I think there's some type of emotional response. And obviously in California and other places it's already well north of $5. But looking at the national average, if we get above $5 and if it blows through $5, I think there's an emotional response to consumers that happens if they start seeing that at the pump.
Yeah, I agree. I For the first time in years, when filling up, got cut off at $75 on the at the pump. So like, man, it's been a while since we've
Yeah.
seen that, and it is meaningful, psychologically. I agree. So, um, good point, Andy. So if we look at U.S. debt as a percentage of GDP, this is what we're looking at here in this chart by Fred. So you can see where we sit today. About 120% of our annual GDP. So our economy does about $30 trillion a year, and we're sitting at about 38 trillion in debt. So um, not a great place to be from that standpoint. Um, so we're that's certainly something that is working against our economy, our ability to grow. Inflate out of it is always the easy go-to line for economists. We can inflate our way out of it, but that gets more and more challenging. Uh, at this point with where yields are, with where we are in the economic cycle, et cetera. Next point. Well, let's go. I tell you what. Let's run through a couple more. So one thing that we're hearing a lot about right now is this K-shaped economy, and the wealth effect, where you have consumer sentiment actually declining, while the S&P 500 has continued to march higher. So you can see on this chart that the shape here is obviously a K. Markets moving north and sentiment moving south. Higher income households tend to do better when markets are going higher, but lower and middle income consumers are increasingly being pressured, particularly with affordability, credit stress, and inflation fatigue. So not a great scenario across the board. And Andy, you made a good point earlier when we were talking about this K-shaped economy. If you want to give that little tidbit to our listeners, that'd be great.
Yeah, it's really interesting. So obviously we're always trying to look forward and try to see what's coming and whatnot. A piece of data that we follow is the 90-day delinquencies. So basically debt payments that are 90 days delinquent. If we look at credit card and auto delinquencies, those tend to be leading indicators of where the economy is. And looking at those, they've significantly gone up over the past 2 years to a period, back to where we were, back in the financial crisis, and near the end of the bottom of the financial crisis. So it's really, one thing we're talking about is, well, what does that tell us? Is that still a good data set, or is it truly representing what this is showing us here? The have and the have-nots, which we've had an issue with that for quite a while. I mean, decades. And we're seeing this is a great example of the gap between the way the average consumer, average American feels, and maybe we're seeing that in some of these short-term debt payment issues, relative to what the market's doing, and who tends to have more and to gain from this type of situation. It's the upper middle class. It's the higher income households and families and people who've already accumulated. The accumulators are accumulating more. So it is K-shaped economy is a very common term that we're hearing out there. So it's something that I think this really represents that well, and it's one also that that the high end spenders are keeping the economy going. They're spending and they're peeling off part of their portfolio, and they're continuing to spend, which continues to employ those on maybe the more labor type jobs, and it's something that we have to recognize, and a weakening maybe of the middle class, which for so long has been the strength of America. It is a different scenario today than maybe we saw 20, 30 years ago.
Yep. Well, let's flip to the other side of the page here. There are quite a lot of positives uh, working in our favor right now for the economy to continue to grow. So let's start off here with the massive amounts of investments made. We've shown this slide a time or two in the past, but it's very impactful. So these are the four of the hyperscalers: Microsoft, Meta, Alphabet, and Amazon, and just the amount of spend that continues to pour in on AI, semiconductors, cloud infrastructure, data centers, et cetera. All of those things just continue to support GDP growth, can continue to support corporate earnings. And in turn, we've seen equity markets have a nice run, particularly in tech and some of these major players in the space. So all in all, this is great for the economy. It's great how it turns out, and who actually ends up making this profitable is YTD. But we will get there eventually. There will be winners and losers in this space. We don't know yet, but the amount of money that's being put to work in the space is certainly positive for markets and our economy as a whole. Another positive tailwind for the economy go forward. One here is the resilience of the consumer in our economy, which Andy mentioned briefly. It's really pretty astonishing to see how well, despite higher prices and higher interest rates, consumers are still spending money, and they've remained surprisingly durable. I think part of the reason why is that we've seen pretty healthy wage growth, and household balance sheet, at least middle and up, have remained pretty stable, pretty strong. So consumer is such an important piece of the U.S. economy. So if we get companies spending, we get consumer spending. Certainly positive for equity markets. Um,
And I think,
another,
Brian,
yeah,
a-
go ahead.
adding on just a little bit to the previous comment about just AI and whatnot, there's a high likelihood we are at the beginning of some new revolution. I think back to the Industrial Revolution, how much changed over that time period. And there were fears. I mean, the factory workers, there were significant fears of, what would happen with automation and whatnot. And with that, there was pain. And there was some people and some jobs that were lost and never came back. And, you can see some of that in Kentucky. But, with that came this whole new revolution. And, you look at that with what technology is enabling us to do. I always tell people, look at our office. My goodness, 40 years ago, 30 years ago, we would have to have 3 times the amount of people. But you look at all the things we can do, and then how many new offices there are like ours across the country that employ people, and then all the tech people that are employed by all the vendors we use and whatnot. So I do think we have to recognize we are at the beginning of something that probably is pretty special. We can obviously go to the fear side and say, gosh, they're going to take over the world, and we're all going to sit on the side of the road and not have a job or be able to do anything. But I think human ingenuity will prevail over that. And I do think, similar to like the internet coming out, and you think about retail sales, like people want to do things, people want to consume. We are a consumption-based economy. It's what got us to where we are. So that will continue. It's just innate in who we are as Americans. Um, and I think what the technology allows is this whole new type of economy, this whole new sector of growth, and like the internet coming out, where there wasn't the internet wasn't necessarily profitable in itself. Maybe AI isn't profitable in itself, but all these new companies that can utilize that can, continue to provide and create new opportunities for both employees, employers, retailers, across the board. There's so much opportunity with that. I just want to underscore that as a positive. I think, sometimes there's a lot of fear around that, but I think there's so much opportunity and so much new innovation that will come from that as well.
Exactly, and with improved efficiency, hopefully, we get some deflationary kind of movements.
Without
Where
a
the
doubt.
Fed can actually get inflation down to their target, and hopefully support long term growth as well, and lower wage pressures. There's lots of positives with moving towards automation. So thank you. Uh, let's go one forward here and talk about how strong the labor market's been. So employment growth obviously is down from peak levels, but we just added 115,000 in April. Unemployment rate remains at historical lows, and layoffs remain limited. Um, that all those things help support consumer confidence, help consumer spending, and just it's the labor market's been incredibly resilient as well. With everything that we're facing, so super positive on that front. Um, One more forward, and U.S. companies, we've mentioned they continue to beat. We've had a great earnings season so far. Q1 continue to post strong margins, earnings growth despite higher input costs. So it helps support equity valuations, and markets certainly been a benefactor of that to date. A couple other things to mention. I don't want to go too deep into them, but obviously fiscal stimulus and government spending that we've seen that creates liquidity for markets. It creates, all these spending in infrastructure, defense, all these different things that just provide liquidity and provide, a strong backdrop for the economy and for equities. We mentioned productivity improvements, and then just market momentum, and investor confidence is definitely a tailwind. So strong momentum, especially in the growth sectors, investor confidence, and continued earnings, and all those things are supportive of risk assets. So a lot going on. Those are all the prepared remarks that I have. Andy, I think if you want to wrap it up with your thoughts on maybe where we go from here.
Yeah, definitely. Thank you, Brian. Big picture, I think what do we, as we take a step back, obviously there's always headwinds, there's always tailwinds, there's always things going in our favor, going against us. How do we handle that as advisors? How do we think about that as investors? And as we look at our balance sheet, how should we think through this? So as always, there's opportunities to make good decisions in any economic cycle and any market cycle. It is cyclical. Things are going to go up, they are going to go down. To quote John from 20 years ago, and he said it multiple times since then, if we're not in a recession, we're working towards a recession. So that word gets overhyped. Where we are, who knows? It's been used a lot over the past 10 years. I think what's important is let's just continue to make good decisions. We talked about inflation a little bit ago. The worst thing we can do in an inflationary environment is, own assets that don't participate in inflationary environments. We want to maintain an asset allocation that makes sense for us. We want to think through liquidity needs. When there is a market change, we want to think, positively about what we can do with that. If it's in a low market, there's opportunities to do conversions. There's opportunities to get rid of, positions that maybe we've had a hard time getting rid of in the past. If we're in a high market, let's not overshadow. We are near all-time highs. It is good. The market has done really well. Let's look for opportunities to make good decisions there. Maybe it's, hey, let's pay off this debt that we've been working towards. Maybe it's, let's fund a donor advised funds. There's so many opportunities to make good decisions along the way. It is a cyclical environment. Things go up, things go down. We're anticipating that. You're never going to be able to fully avoid any of that. So I think just make good decisions, continue to review your plan. Brian, I want to thank you for doing the legwork on all this information, continuing to lead our investment team, our investment committee. We try to do these once a quarter. Our investment team meets once a month. Brian looks at this all day, every day. So thank you for the diligence there and building portfolios where, really over the past almost 20 years now, we've really stayed the course to our philosophy and how we manage money. So kudos to you with that. Obviously, portfolios continue to do well. So thank you all for joining us. We appreciate the time. Hopefully, y'all learned a little bit. And if you have any questions, don't hesitate to reach out.
Thanks a lot.